Thanks, Jose, and hi, everyone. I'm going to go and talk about our macroeconomic outlook for this quarter, including a discussion of our global economic outlook, how that's affecting Asia-Pacific, also a little bit about how monetary policy is playing out in the region, and some of the key risks that we're watching out for as we enter these uncertain times of fresh pandemic waves. Turning first of all to our forecast updates, we recently revised these at the end of June. The summary for Asia Pacific is that we forecast growth of 7.1% this year, following a contraction in activity in 2020. This is about 20 basis points lower than our previous forecast, but we still expect fairly steady recovery into 2022 as things start to normalize and some of the base effects fade out of the data. In terms of the key themes that are driving our APAC forecast this round, on the upside, we have trade performance. So a number of our upward revisions, including China, South Korea, and even in places where we downgraded, trade and for international trade have been the key drivers of upward revisions and support to growth on the positive side. On the negative side, we have fresh pandemic waves and lockdowns that are still affecting the region's outlook. The recent uptick in COVID-19 cases across the region presents a further risk to some of these outlooks, even in places where COVID has previously been under control. While we continue to see these intermittent lockdowns, the pandemic remains the key risk to our forecast for the region. Turning to some of our specific numbers this round, for India, we've revised our growth outlook lower to 9.5%. This is on the back of the severe COVID second wave that we saw there the early part of May. Similarly, for Malaysia as well, a large downward revision on account of their lockdown. In terms of some of the upward revisions, in China, we have upgraded our growth forecast slightly to 8.3% for the full year. This implies a steady pace of economic activity throughout the year. We continue to anticipate a gradual rotation towards consumer spending, while the boost from trade and investment will fade out gradually over the course of the year. One point to note for China is that our forecast for 2022 is 5.1%. So visually, it appears to be a significant slowdown from this year. However, I'd just like to point out that in sequential terms, we actually see fairly steady activity over the course of the second half of 2021 and 2022. So this is really base effects in 2021 that are boosting the growth number higher, but we do not anticipate any significant slowdown in activity next year in the numbers. Turning more globally to our outlook, we anticipate that growth in the US will be 6.7% this year, followed by 3.7% in 2022. A healthy recovery is now underway, helped by strong fiscal stimulus, as well as the gradual reopening of the economy. A similar story is playing out in the eurozone. The eurozone first quarter activity was slightly weaker than expectations, but we anticipate that the gradual reopening of the economy is now starting to feed through to the data, and we expect growth of 4.4% in 2021, and an upward revision of about 20 basis points. So turning now to our story on China, where we see activity being driven by a couple of key drivers. And it turns out that consumer spending is not one of them. Let me talk you through this chart in a bit more detail. So within each category, the rightmost bar shows the medium-term average growth rate for that indicator. So for example, for retail sales, the medium-run average growth has been slightly around between 7 and 8% growth, around the 7% year-on-year mark with the medium run. When we look at the actual outturn for retail sales this year, when we measure it to the 2019 level, compound annual, the way market observers are looking at it, we see that retail sales growth is underperforming its medium run average at the moment. Consumers are still being fairly cautious. On the other hand, we can see that there's strong outperformance on the export side, as well as on the residential property sales side, where really some of the savings that has been built up by cautious consumers is being channeled into property, and this is showing up in the property investment and property price data. The fixed asset investment number is also interesting because so far this year, policymakers have been cautious in terms of dialing up the stimulus to support economic activity. The emphasis has been on maintaining risks in the economic system at manageable and sustainable levels. And therefore, the fixed asset investment activity has been moderate. We saw some recent easing of monetary policy by the PBOC, and this will play into the numbers a little bit, but from our point of view, it still marks marginal easing and not a significant change in the policy stance at the central bank. So turning now to some of the global factors that are affecting APAC economic activity, one of the key ones is certainly the US economic recovery. So the US is currently among the most recovered economies globally. So we do see that consumer activity in the US has picked up far quicker than the rest of the world. And one of the key drivers so far has been durable goods spending. So this chart shows the indices for the various components of personal consumer expenditure, and durable spending, as you can see, was a key outperformer over the second half of 2020 and the early part of this year. But now some of that momentum is coming off. And what consumers are doing is that they're shifting back into services, which is the more traditional pre-COVID expenditure preference for consumers. So there's on the graph visually, there's a slight uptick for the services section of PCE, but this is a very large category. So services account for about 70% of the total PCE basket, which means that slight changes in the services number will move the overall number significantly. And this rotation is now gradually underway. We can see the pullback in durable goods spending, the slight uptick in services spending, and that should only play out for the rest of the year. One of the key factors that has been holding up recovery in the US is that households have built up their savings over time, particularly in the later part of last year, while stimulus checks were arriving from the government, but spending activity wasn't back up. So there is this saving buffer to run through, and we expect that consumers will go through that through the course of this year. In the eurozone, a similar story is playing out, but the magnitude is much more modest compared to what we see in the US. There has been stimulus in the eurozone as well, and as a result, household incomes in 2020 held up. These were largely flat year on year in 2020, even though the economy shrank by more than 6.5% last year. However, the recovery in consumer spending hasn't been as sharp as what we see in the US. In the first quarter of this year, consumer spending was still recovering from lockdowns and the hiccups in the early vaccination drive. And as a result, we only saw the consumer side of the economy picking up towards the second half of Q2 last year. We can see that in some of the numbers now. Manufacturing was the key driver of the economy since the second half of last year and through June this year. However, finally, the services sector activity is now picking up. And we expect that that should also continue as economies gradually open up. One of the key factors for the Eurozone outlook is the Next Generation Fund. This is going to affect investment spending in some of the periphery economies in particular, and this is also going to provide a boost to growth over the medium run, and it should provide a boost to investment activity in the Eurozone. So there's a contrast with Asia Pacific at this point in time with the story that we have seen in US and Europe. And the key contrast here is that in Asia, consumers have been relatively more cautious. We've seen consumer spending lag overall GDP growth quite significantly as compared with the US and Europe. One of the factors has been that lockdowns and intermittent lockdowns are still a part of the landscape here in Asia Pacific. However, there's more opening up in the US and Europe at the moment. The other part of the story is that consumers have been more cautious and less confident about the recovery in APAC for now. So visually, we can see this on the chart on the right, for where we see that the gap between consumption and GDP has been widening even out to Q1 of this year in APAC. So growth was outperforming consumption, and there has to be a factor that kind of supported growth, and indeed that factor was international trade for Asia Pacific. Trade has been a significant growth support for APAC over the course of the past several months. We've seen exports outperform imports quite consistently. We saw current account balances improve for much of the region, and indeed for the moment that trend has continued. However, we did see that consumers are now spending a little bit more on services in the economies where recovery is underway. And this means that merchandise trade momentum is going to fade a little bit. So we're going to see the growth rate of exports start to fade a little bit as we enter the second half of this year. Some of the merchandise trade spending will be moved to services. However, tourism travel is and that kind of international spending is still not on the agenda, which means more domestic service spending. All in all, it will mean that while trade continues to be a growth driver, the magnitude of the support that trade is providing is going to fade as we enter the second half of this year. One area where we see that story quite clearly is electronics. So electronics were the earliest component of trade to pick up, partly driven by the global work from home drives and people upgrading their home IT infrastructure, etc. But it really was a big boost to the merchandise component of trade for a significant period of time. And that has been slowing over the recent months, as we can see on the chart on the right. So electronics will continue to support growth for this part of the world because the region is a big supplier of semiconductors, which are in global shortage at the moment. However, the momentum has certainly started to ease. What does all this really mean for APAC's growth outlook? So on the one hand, we have the slowing down of trade, and on the other hand, we have slowing or slow to start consumption. And really, this means that the turning point or what the outlook kind of rests on is the outlook for private consumption spending. That component of GDP growth has to pick up, and consumers have to start feeling confident about the economy and about the recovery so that they can go out and spend and continue the economic recovery path that we've seen so far this year. And for that to happen, the key swing factor is really the vaccination effort in Asia Pacific. So once we get this broad vaccination rolled out and average efficacy of vaccines increases, we get to the point where consumers start feeling more reassured about spending, and the possibility of intermittent lockdowns eases a little bit. But for the moment, vaccination drives are still lagging behind in APAC. Supply and logistics constraints are still holding back broader vaccination efforts. In particular, the region was fairly slow to start off with vaccination efforts. And for a number of economies where the pandemic was under control, vaccination rollout could have been earlier, but was delayed for a time being due to supply and various constraints. Among the higher income APAC economies, this is now changing quite quickly. There has been a significant scale up of the vaccination effort as economies realize that the way to open up is going to be through getting everybody vaccinated against future pandemics. However, for emerging Asia, the situation is a little bit trickier. Logistics constraints are still holding back the speed of overall vaccination drives. And this means that for emerging Asia, the reopening timeline is going to be pushed back while vaccination drives get underway. What does this translate into for the economy this year? It means that we continue to see intermittent lockdowns of the kind recently imposed in Malaysia, Indonesia, Thailand, etc. This means that mobility is going to be below normal for a considerable period of time. And due to variants, etc., we do see that lockdowns are also a feature now in places where the pandemic was previously under control. And this is why it remains really a key risk to the economic outlook, where if we do not see a significant pickup in vaccination coverage, we could run the risk of seeing intermittent lockdowns that will pull back private consumer activity. So turning now to our monetary policy outlook, one thing that is affecting the region's inflation outlook is the output gap. And here we see that output gaps in the region are still significantly wide. So this is the result of weak consumer demand and consumers holding back a little bit. And we can see that really in the activity levels, which are still far off where they should be. So on this chart, 0% is the level at which activity would be matched to its current potential level. Based on the pre-COVID trend and corrected for time effects. However, we see that activity for the region as a whole is actually 4% below that. So it's significantly below that mark, and it's already looking like it's flattening out a little bit, which means that for the time being, we see wide output gaps and limited pressure on underlying core inflation. There are two kinds of inflationary pressures in the environment at the moment. So we see, on the one hand, the cost push inflation that's really coming up from the side of commodity prices, energy prices, etc., which are driving up the producer prices as well as the energy components of inflation across the world. And the other side of the story is the demand side, where we see shortages in supply running up against returning demand, and this is driving core inflation higher. Of the two kinds of inflation, the latter, where we see the demand side coming into play, is definitely the one that causes more concern for monetary policy in the region. However, because of the wide output gap that we just saw, we do not anticipate that this is a major concern for the region for the time being. In fact, when we look at core inflation in the region, it is still very subdued, and the fresh economic downturn that we've seen in this part of the world means that core prices are actually coming down further. So on the domestic side, because of demand gaps, core inflation is not a concern for us at the moment. However, this is not true in the US, where returning demand is running up against these supply constraints and labor shortages, and we do see some pickup in core prices. I want to talk a little bit about these two charts on the slide. On the left, we see that so the left chart shows oil prices on the right axis, as well as headline inflation for Asia Pacific as a whole on the left axis. And there's two takeaways from this slide. So one is that oil prices do have a bearing on headline inflation in this part of the world. We see that when prices fell, particularly over the period between November 18 and middle of 2020, there was eventually a drop in the headline inflation number. However, the other key message is that the pass-through from oil prices to headline inflation is actually quite low. So what we saw, for example, is that Brent prices fell from a peak of about $80 in the middle of 2018 to a low of almost around $25 last year. And during that period, inflation only fell by much less. The magnitude was about 1 percentage point, and that too only with a significant lag. So this means that the current rise in oil prices will push up headline inflation due to base effects as well as due to the energy price component. However, the magnitude is unlikely to be large enough to really move the dials for monetary policy. So turning to the chart on the right, and I'll link the two charts as well for really quickly. The chart on the right shows the three components of Asian inflation. So on the line that is a little bit more volatile, we see producer prices in Asia Pacific. We also see on the same chart headline inflation as well as core inflation. And really the key message is that the pass through from producer prices to headline inflation is very low, and that core prices in the region have been very stable for a long period of time. So one quick linkage between oil prices and the chart on the right is that there's two ways that those two connect. So oil prices have a very strong correlation with producer prices in the region. So we do see that when oil prices rise, producer prices rise, and which is what we are seeing in the current environment, backed by broader commodity price increases. We also see that an increase in oil prices also has a significant impact on energy consumer prices, which is the key, which is one of the components of headline inflation, but not a significant component in this part of the world. So the final takeaway, I guess, from the two charts is that we do not expect this cost push inflation to be a significant concern. And on the other hand, because of the large output gaps, we expect that domestic demand will push core inflation lower in APAC. So domestically, there should not be a reason for monetary policy to tighten at this point in time. But I do want to turn to the US inflation outlook for a minute, because that is ultimately going to influence how central banks in this part of the world react. So Asian central banks have typically been very sensitive to the US Fed, both because of capital flow pressures, exchange rates, and as well as global monetary conditions, which are quite influential for the region. In the US, there is a little bit of a different dynamic than what we are seeing in this part of the world. There is this cost push side of inflation, where we see the higher commodity prices feeding through to headline inflation a little bit, but not so much. But there's also this other side of the story, where we see domestic demand really picking up. And because of the downturn, some of the labor force has exited the market. We see participation rates have fallen a little bit, and this means that there is cost pressure from the supply side as well. And this is pushing up core prices noticeably. So turning a little bit to this chart on the right, we see here in the light blue line where we see the core CPI numbers, this shows the actual path of core inflation over the past couple of years. And in the recent months, there has been a significant uptick, and we can see that that line is now sharply sloping higher. The dark blue line shows what the core inflation index would be in the absence of the pandemic. So if the pre-pandemic trend just continued over on from February 2020, then this is where we would be. And the message from this chart is that now we are at the point where inflation is where prices are higher than where they would have been in the absence of the pandemic. So there is definitely this this uptick in inflation that we do need to watch out for. The Federal Reserve is rightly pointing out that some of these pressures are noticeably transitory. They account for things like things that are spent during the pandemic period, so used cars and similar components, which have taken sharp price increases over a short period of time, but which are expected to fade as consumers change their patterns back into more normal patterns over the course of the rest of this year. So there is that element, and indeed we should see some of that play out, where we see the momentum of this core price pressures fade a little bit. The risk is that inflation expectations rise, and we do see that core inflation remains higher than the 2% mark for a sustained period of time. In this case, the central bank might have to act and tighten policy quicker than its current forecast. For the moment, we forecast that the Federal Reserve will only tighten policy in the early part of 2023, We do anticipate that they will taper asset purchases in the later half of this year, which could be the first signal of things normalizing for monetary policy. So turning to the other side of the story for the Federal Reserve, the labor market. And here, the labor market is clearly not fully normalized as of yet. So we see the participation rate is still well below what it used to be pre-pandemic, and the economy is in fact short of 7.5 million jobs. And this is what the central bank is watching out for when it decides what to do with monetary policy. One link between APAC central banks and the US is the interest rate differential. This determines how sensitive the interest rates in the region are going to be when the Federal Reserve eventually tightens policy. These gaps, because of the pandemic, have been pushed well below normal levels. So the interest rate differentials in Asia Pacific are right now significantly narrower than what they are on average. This means that slight upticks in the Federal Reserve policy rate will lead to could lead to more capital flow pressures in APAC than under normal circumstances, because the attractiveness of APAC yields is a bit narrower than normal. So that is our key second risk for APAC at the moment. So in addition to the pandemic, which is the key risk, the second risk is that any normalization in global monetary policy could leave central banks in the region in a tight spot with what to do, because they're facing weak domestic demand, but also could be facing capital outflow pressures at the same time. I want to take a minute to summarize our narrative for Asia Pacific, as we just discussed, starting off with the global recovery. So we do see a global recovery is now underway as economies open up. In the US and eurozone, consumer spending are driving that recovery. We see that consumer spending will continue to be a key growth driver for the second half of this year, while economies remain open up. And the nature of that spending will shift increasingly towards services and away from goods. On the other hand, in Asia Pacific, consumer demand is lagging behind as economies are still in phases of intermittent lockdowns, and vaccination drives are picking up now, but are still have been slow to start. As a result of the shift in consumer spending away from goods, trade is going to be a little bit weaker than we currently anticipate, and this means that the onus is going to be on consumer spending to recover and drive growth for the region. Ultimately, this means that vaccination efforts are going to be a key determinant of the APAC recovery. Higher inflation from cost push in commodities is unlikely to persist in APAC at the moment. Energy prices will rise, but not by significant amounts. On the other hand, core price pressures are likely to be subdued. Finally, there are risks for emerging markets from any policy surprises in the US stemming from rises in core inflationary pressures that are currently unanticipated. So with that, I'd like to hand over my presentation, and thank you for your time. So thanks for sending your questions through. We do have time for a few questions from the audience. Starting off with a couple of related questions that we've received. So the first one is, if US inflationary pressure is rising, will that have a negative flow effect to EM if market pricing higher inflation expectation in US bond yields and higher US dollar? We also have a related question that is more generic. What is your outlook for APAC currencies given recent volatile market moves? So these are indeed great questions that we definitely need to be thinking about quite closely in this at this point in time. There's two factors I think that are relevant for capital flows in the current environment. One is, of course, the stronger US growth, which is one of the factors that is causing pull pressures towards the US side away from EMs a little bit. And the second is, of course, US Fed monetary policy. If we get to a point where the market starts to price in noticeably quicker tightening from the Federal Reserve, particularly if inflationary pressures are not contained over the next few months, there's increasing noises from market participants that we do not really see inflationary pressures fading as quickly as we expect. And if that continues over the next few months, then we could see this early 2023 number for the Fed pickup of interest rates start coming back towards the middle of 2022 or early tapering, those sort of things. And that would definitely be a noticeable headwind for the EMs. It could result in something similar to the taper tantrum of 2013. Economies are a little bit more resilient in the current environment, given that current account balances have narrowed. The deficits have narrowed for the deficit economies. Surpluses are also somewhat more moderate in the surplus economies. So it's unlikely to lead to that kind of volatility. And nevertheless, we could definitely see capital outflows. We could definitely see a change in direction on the FX front. So turning to the question on the FX, what we've seen over the past year is that there's been this period of US dollar weakness. There's been a risk-on element. The EM currencies have held up reasonably strongly. We have seen that changing over the past couple of months, where we've just seen some of the momentum fade a little bit. And gradually that could reverse if this monetary policy angle plays out. And certainly, if the EM central banks feel pressured to respond to weakening currencies, that would also affect our growth outlook in the sense that it would be poor timing. On the medium run, the factors that are affecting our currency outlook are still the same, which is we look at the persistent current account balances, either on the surplus side or on the deficit side, as well as inflationary gaps between the currencies, which will determine, how the path of the APAC currencies plays out. Essentially, for the EMs, it's going to be continued moderate depreciation for several of the APAC EMs over the next couple of years. We do have a couple of other questions, and I will group a couple of these to address as many as possible. Why are GDP growth outlooks in certain regions lower in 2022 as compared to 2021? We have a similar question. Can you elaborate with details on why 2022 forecast will decrease versus 2021? And these are great points. I think my one-line answer is that base effects are going to be very influential this year. And let me elaborate a little bit more on that. What we've seen in 2021 is that due to the weak base of 2020, we're seeing this significant jump in the year-on-year growth rates this year. So we saw large or sizable economic contractions almost across the world in 2020, and that led to a significant drop in output. And what we're now seeing in 2021 is just a slight return towards normal. But because we're comparing that against a very low base in 2020, what we see is that the growth rate is quite high. That base effect is now fading out in 2022. So it's not really that 2022 is a significant slowdown in growth. When we look at it sequentially, comparing it with the previous period, actually growth remains fairly steady in quarter-on-quarter terms. However, when we compare it with the growth rate in 2021, we see this slowdown. So I guess my key takeaway here is that this slowdown in the numbers in 2022 it's mostly arithmetical. It's not something that we actually see or anticipate in the macro outlook. We do have a couple of other questions. One question is, what is your outlook for Indonesia, considering it is facing a pandemic wave? I will group that with another question, which is that is the current fresh pandemic waves affecting economic growth in parts of Asia? So both are currently among our top concerns, indeed. So for Indonesia, just last week we've revised lower. Our fresh growth outlook is 3.4% for this year, 2021. Earlier we were at 4.4%, so about a 1 percentage point drop due to the fresh escalation in the pandemic. Similarly, across EM Asia, pandemic waves are affecting the growth outlook quite significantly. We do expect further intermittent lockdowns across the region. Some EMs are a little bit better placed in terms of vaccination schedules, etc. However, clearly the top concern among the emerging markets right now is COVID and whether that pandemic can be brought under control in short order. So we have one other question on monetary policy, which is, are central banks in Asia likely to tighten policy soon? This question is related to, I guess, the first one that we answered regarding the change in US Fed. So at the moment, I think the short answer is that we do not expect any noticeable tightening in central bank policies across Asia Pacific. There's a couple of exceptions. In South Korea, the central bank has clearly highlighted a preference for moving at some point, probably this year. It could be as early as August. However, that's being delayed at the moment. It could be delayed by about a month or two. In New Zealand as well, we expect tapering. For the emerging market central banks, there's this conflict that the central banks are facing. On the one hand, they have weak domestic economies and low core inflation. On the other hand, there is this threat of capital outflow pressures that we just talked about, and there's this potential swinging axe, which is that we could see US monetary policy tighten a little bit quicker. That could lead to capital outflow pressures, currency depreciation, and the central banks, I think, do not want to deal with that at this point in time. I think ultimately that will mean that they'll be very cautious in terms of easing policy at this point in time. However, we certainly do not expect that they will tighten. So we don't have time to address all the questions that we've received. Thank you for sending those in. We'll take those offline. But we can now move on to the next segment where we'll hear from Audrey and Catriona on company fundamentals and Asia Pacific's recovery. So thank you for your time.